So very good morning, Mr. Gottstein. I wonder if I could just start by asking you if you could just sum up the quarter for us and tell you how you feel about how the bank has done.
Thank you very much for having me. No, we are very satisfied with the second quarter. As you may have seen, we were up about 11% in terms of revenues. Our pre-tax income at 1.6 billion and net income at 1.2 billion. Were very solid results. If you take the first half, this has been actually the highest net income attributable to shareholders in the last 10 years. We have a strong balance sheet with a CET1 ratio of 12.5%, so we're very satisfied.
One of the issues that the market has been worried about, obviously, as we've come through the first half of the year and particularly the second quarter, is the threat of credit impairments and how banks are responding to that. You've actually given us a lower number than the market was expecting for the second quarter. What does that indicate about credit quality and the market that you're seeing?
Yeah, we had just under 300 million of credit provisions, which takes our total for the first half at 900 million, which is about 12 times higher than the average over the last 10 years. So in historic terms, it's still a very big number. But if you look at our credit book, it's actually a very solid credit book. Out of our 300 billion roughly of loans, over 80%, I think it's 84%, is actually collateralized. 60% of that loan book is in Switzerland, where the credit loss history is quite robust. So we obviously, as a US GAAP reporter, followed all the CECL macroeconomic modeling. But given that we were already provisioning almost 600 million in the first quarter, that really brought us to this roughly 900 million for the first half.
So as we look at the outlook on that provisioning, is it your expectation that we have seen the peak of the crisis now and you would expect there to be less provisioning over coming quarters?
Well, the way that CECL works on the US GAAP is that you obviously have to reassess your macroeconomic assumptions every quarter, and we have to see now how these forecasts will develop over the next few quarters. So it's difficult to make a prediction, but directionally, I think we have now factored in our best possible way to forecast the impact of COVID-19 on macroeconomic development going forward. So in theory, we should expect lower credit provisions going forward, unless, of course, the macroeconomic assumptions change to the worse, which we all hope will not happen.
So in terms of profitability and the outlook for return on tangible equity over the second half of the year here, how much better than the 11% you've delivered here can you do?
Well, it's very difficult to make short-term predictions over the next 2 or 3 quarters, as you can imagine, because nobody really knows what COVID-19 will ultimately produce over the next few quarters. Will there be a vaccine, etc.? But we made 12% return on equity over the first 6 months. We made 10.4% over the last 4 quarters. So I will not make any predictions for the second half. Usually the first half is stronger than the second half, so we'll have to see how things develop. But our midterm targets are unchanged. We want to deliver 10 to 12% return on tangible equity through the cycle. And after all the work that we've done over the last 5 years, we are now, I think, in a position where we can deliver that.
One of the trends that your predecessor introduced, I think, as a consequence of the world post the financial crisis was a continued de-risking of a reduction of risk-weighted assets. As we look at the earnings announcement today, you have continued that with the reduction of risk-weighted assets. Is that going to continue from here on in? Tell us a little bit about the direction of travel for those assets.
Yeah, our risk-weighted assets were broadly flat between the end of the first quarter and the second quarter. And you have different things. You have business growth, you have volatility, you have model changes. So the direction of travel, has been up, as we saw, because even though we reduced our overall leverage and balance sheet over the last 5 years, risk-weighted assets went up and our risk density went up. So, and there will be at some point, Basel III introduction of FRTB, etc., which will come in 2023. So the direction of travel is up, but we are also now generating capital through profitability, and therefore our midterm target of a CET1 ratio of 12% is, in my view, a realistic one.
The cost side of the business saw a modest increase, but I think you'd probably describe that as flat here. How much are you focused on maintaining pressure on costs into the rest of the year?
Yeah, cost is very important. We managed it down from over 21 billion to below 17 billion over the last 4 or 5 years. And you're right, costs were 2% up in the second quarter, but for the first half they're down 2%. So we have to continue to focus on cost discipline, and our target for the full year is to be between 16 and 16.5 billion in terms of costs. So we feel reasonably comfortable that we can maintain that discipline.
And obviously you've taken this step here to create the global investment bank that brings together some of those businesses that were unwound under Tidjane Thiam. Can I ask you why specifically you're doing that? Will that allow you to push through even further cost reductions while maintaining the same level of operating efficiency?
Well, when the restructuring happened in the years 15, 16, 17, we had to separate the trading business from IBCM at the time, because we had to de-risk the trading business, and we wanted to kind of protect the IBCM M&A capital markets business. But bringing them together was something we already discussed a year ago. So it was something that was planned at some point, and now is the right time to do that. I have not met one single person within the firm who's against that move. It was a natural, obvious next step to do. This is less about cost, but there are some cost benefit, but it's really about improving the collaboration, for example, in the underwriting capital markets business, where we had a 50-50 joint venture. It makes things more complicated. So, or equities, we want to have a global equities business. So it's really something that was a natural next step.
Obviously, there have been some missteps in recent years. I don't want to dwell on too much what Tidjane Thiam was involved in, but the markets have looked at your involvement with Luckin and Wirecard, and they've asked questions as to whether your integrity and your oversight was robust enough as you engaged with some of these businesses. Is this going to continue, or are we seeing a culture change at Credit Suisse?
Not at all. We're actually very satisfied with the compliance and risk procedures in overall, and I'm not going to comment on individual cases, but we are number one in IPOs globally in the first 6 months. If you do a lot of transactions, sometimes that's part of the business. So we have not combined risk and compliance because there was any shortcomings in terms of those second line of defense operations, but it was because we were at a point where effectiveness, especially non-financial risk, be they anti-money laundering risk, reputational risk, cyber risks, etc., where we can be more effective by doing that. Also technology, we had a technology team in compliance, we had a technology team in risk. And if you look at our cost base in the last 5 years for the combined risk and compliance function, we went from 700 million to 1.3 billion. So this is really about being more effective, being more efficient, and working seamlessly together between those two functions.
And Thomas, as we wrap up, I just want to circle back to the numbers here. As I look at the pre-tax income number from the international wealth management business, it's a 3% gain here. It's somewhat weaker than we've seen in all the other markets related operations, be it investment banking or trading. What do you need to do to get international wealth management firing on all cylinders to lift those numbers? Is there a problem with the business?
Not at all. I mean, if you look at our global private banking business, the first 6 months, there's a good slide in the presentation that you may look at, that we're actually up, if you adjust it for FX, by 7% in the first half compared to the first half 2019, in an environment where we had the biggest macroeconomic reduction we've seen in decades. So to be up 7%, FX adjusted, is actually a very good business. IWM within that was obviously suffering from some FX headwinds, because most of that revenue is either in dollars, in Brazilian real or euros, and we are reporting in Swiss franc. But if you adjust it for that and certain one-offs, the business is doing very well. We had very good NNA flows, and Philip Wele and his team are doing an excellent job. And we have identified a few initiatives that will further accelerate this growth.
Good to have you on the program, sir. Thanks so much for joining us this morning.
Great to have you, Jeff. Take care. Stay
Lovely,
safe.
Thomas. Thank you. Have a good day.
Bye-bye.